Coming off the back of a week that saw a major reaction to the US jobs report, speculation over where the Federal Reserve could go next, a rate cut from the Bank of England just about, tariffs coming into play globally from the US, and lots more. This coming week has plenty to sink our teeth into, most notably the US CPI report, given the shift we've seen in terms of sentiment towards the Federal Reserve. How's this going to shape things up? So a big week ahead. So let's get into the week ahead for the week starting Monday, the 11th of August. So first and foremost, let's just jump into the big ticket items according to Trading Economics. And we can see it here. The week really sort of kick starts on Tuesday. We've got a raft of data points. And like I said, the big ticket item really comes on Tuesday out of the US. It's the inflation report coming out of the US CPI numbers. And that really is going to be the big ticket item of the week. Aside from that, we've also got the RBA interest rate decision on Tuesday, Monday night coming into Tuesday, depends where you are in the world. And then we've got the jobs report out of the UK. So really Tuesday is the sort of the big day for markets. Thursday, we also see more data coming out of the UK, GDP data alongside PPI from the US, GDP from Japan, moving into Friday. Industrial production, well, a raft essentially of Chinese data points coming out on Friday. And then we've got retail sales in Michigan, consumer sentiment and inflation expectations. Those are the big ticket items, but there's more aside from that. But like I said, really this week's going to be revolving around that US inflation report. Now, of course, markets have grown increasingly confident that we're going to see rate cuts at pretty much every meeting from here on in. And that came off the back of a jobs report that was an absolute shocker. Yes, we saw a weak payrolls number. Yes, we saw a high or higher unemployment rate figure. But really, the reason why it's a shocker was the downgrade to the prior 2 months. We saw a huge revision of 258,000 jobs revised out of those 2 months. Essentially, all of a sudden, it just tells you that everything you had believed wasn't true. The strength of the US jobs market was not true, and therefore the Federal Reserve looked like they're behind the curve. If they had known that the jobs data was coming in like that, maybe they would have taken a bit more of a proactive stance. They didn't, and they do now. So markets think that they're going to act in a very decisive manner from here on in. Like I said, we've got that inflation report on Tuesday, and this really highlights the fact that the Federal Reserve weren't necessarily only holding off in terms of cutting rates because of the fact that we've got the jobs market in a relatively steady place. That's part of it, but it's also inflation, right? So they were concerned about how inflation was potentially about to rear its head once again, in no small part due to the actions of Donald Trump and the policies with the ramping up of tariffs. Now, I would argue, and I have argued for a long time now, that it's the uncertainty of the tariffs more than anything, right? If you're threatening to potentially impose 30, 40, 50% tariffs on nations, and that never actually comes to fruition, then the Federal Reserve don't ever get the certainty to be able to say, okay, we have X tariff on this country, but, you know, it's causing this kind of effect, and therefore we can look beyond it potentially because we at least have certainty in the policy. The fact that he kept pushing that date meant that we never saw certainty over exactly what the policy would be, and therefore being able to judge exactly how that's feeding through into the economy. Now that we have those tariffs for the most part being imposed, you have some degree of certainty. There's still some uncertainty. You've got India potentially going up to 50, and that revolves around the whole Russia story. You've got potentially 50 staying in place for Brazil, but that's a political story. You've got 39% on Switzerland, but they're trying their best to try and bring that down. I think they probably will. Then you've got sector-specific bits. So there's still uncertainty, but we have gained greater certainty with this imposition of many of these tariffs and the trade deals that have been pushed across the line. Nonetheless, we don't necessarily know exactly how much inflation will rear its head and exactly what the response of the Federal Reserve would be. And that's why this inflation report on Tuesday is going to be so interesting. And we can see in terms of market expectations, the core figures expected to remain relatively low, 0.2 on a monthly. Now, the headline number, so the annual number, expected to tick higher. But I would say if you're looking at something like that, if you're looking at a monthly figure of 0.2, that's more important than the base effects impact that drives that core headline number, sorry, the core annual figure higher up to 3%, if that's what happens. Similar kind of story in terms of the headline inflation rate. So 0.2 expected from 0.3. So a decline on a monthly inflation figure. And despite the fact that the annual number is expected to remain steady, the most important thing is whether we see that monthly inflation figure under control. And at 0.2, that's perfectly fine. And really emboldens the Federal Reserve to be able to carry on with their easing if they have that planned for the next meeting. Now, beyond that, we've got PPI numbers expected to move a little bit higher. Retail sales expected to drop off a little bit. Empire State Manufacturing Index expected to improve. Retail sales expected to weaken a little bit. Industrial production, a little bit more weakness. Michigan consumer sentiment, a little bit more weakness. Nothing too stand out there. But of course, if you look at it against the backdrop of like what's market expectations, if you see weakness in terms of the US economy right now, that plays perfectly into the hands of something like gold, because not only do you have the haven aspect of thinking that we're getting economic deterioration, you also have the aspect of that encouraging greater easing from the Federal Reserve. Now, if we're looking at a couple of the charts, let's just look here first and foremost at the relationship between the ISM PMI prices paid elements within services and manufacturing that's just been released over the last week, and the US inflation metrics. I've got the yearly figures, but also some annualized figures. So they're a little bit more responsive, kind of akin to having like a 200-day SMA alongside a 15 or 20, right? So what you can see here is that we've got the 6-month lag that I've added on here that historically has played out. So are we going to see this surge in terms of pricing pressures alongside that surge that we have seen already within the prices paid elements of the services and manufacturing ISM PMI figures? That remains to be seen. Now, certainly there in the last CPI report, it remained relatively under control, but certainly when you pick through the numbers, there are a handful of things, electronic items, clothing, things like that, that we did start to see the effects of tariffs coming into play. So again, people are really going to be nitpicking through it. Do we start to see those tariff pressures rearing their head once again? Markets are expecting a relatively low figure, 0.2 on the monthlies. Maybe that's a low bar of which we're going to end up breaking through. So if we do see an elevated figure, maybe that could raise concerns. Here's the breakdown in terms of the US CPI and core CPI. You can see both on the rise on the headline annual figure. Then if you look at the monthlies, they have kind of moved above where they need to be, but not necessarily in a huge manner. So a little bit elevated last time around, but nothing massive. And that's why this report is going to be so important, because ultimately last time around, people started to say that we're starting to see inflation coming into the fore because of tariffs. Do we finally see it rearing its head once again? Let's jump onto the charts for gold. And whilst this isn't necessarily just a US dollar or the S&P 500, this is heavily related to what's happening over in the US. If I overlay the 2-year yield, you can see here we have a very close correlation in terms of where yields are on the short term and the price of gold. Now, I've inverted it, and essentially if I show you it uninverted, it's like this, right? So what it essentially means is when we see weakness in terms of yields, then we see strength in terms of gold, right? And why would we see weakness in terms of yields, right? So it's the 2-year. The 2-year, if you're looking for something that is going to kind of replicate where expectations are from the Federal Reserve, that would be the 2-year. If you're looking for expectations of the health of the US economy, say concerns around debt and things like that, you'll be looking further out, 20-year, 30-year, something like that. But the 2-year is very responsive to near-term monetary policy. So as we can see here, this collapse here was after the jobs report. So what does this tell us? It tells us that when the jobs numbers or economic data is weak in the US, then people start to ramp up expectations in terms of easing from the Federal Reserve. So we see lower 2-year yields. And so again, if you reverse that, that means that we see strength in terms of gold. And that's exactly what we saw. As we saw expectations of additional rate cuts, so gold pushed sharply higher. That means if we look at the data for the week ahead, if we see any of that data, aside from the inflation side of things, really pointing towards additional rate cuts, that would be expected to provide significant upside in terms of gold. But like we're saying, if we're talking about sort of weakness in terms of inflation, and that also leads us to believe that we're going to see the possibility of additional rate cuts over the near term or greater confidence of that, then again, for me, it's a boost for this precious metal. And if we're looking at the sort of wider spectrum, we take out the 2-year just to give you an idea of exactly how things are shaping up. Let's just look at actually, let's get rid of these short-term retracements because we've broken out from that. So what we're looking at here is we've seen this sort of multi-leg retracement here. That's now going to be better on the daily. There we go. So we've broken through trendline support, but this phase of consolidation still holds, right? By and large, over the past, say, 6 months, is it? Sort of 1, 2, 3, 4. Okay, 4 months. We've spent most our time stuck between sort of this kind of area, sort of 32.60 up to roughly here, 34.40. Right, and we're now in the middle of that. We came into this deep retracement. Yes, we came past the 76.4 fib, but we didn't break the 32.46, and now the bulls are back in charge. We can see that because we broke out from this intraday trend of lower highs, lower lows. The breakthrough, that first swing high signals the recovery coming into play, and now we can see it shaping up once again. So you can see this sort of ascending triangle formation here, there. So looking like we're breaking higher from here. So the bulls are certainly back in charge at the moment, and any indication that we're going to feel more confident of rate cuts from the Federal Reserve provides the basis for further upside. If we were to see the opposite, if we were to see inflation coming in heavy, strong, and it starts to push back against those expectations, that's the kind of thing that could drive gold prices lower over the near term. But certainly at the moment, people feeling quite confident that the Federal Reserve is moving in that direction. And remember, we just saw recently a shift at the Fed that saw Kugler essentially stepping down. It means Donald Trump gets to put one of his own people into the Fed sooner than we had expected. So again, that is a dovish shift in terms of the way that things are shaping up in terms of monetary policy over in the US. Next up, let's look at the UK. The UK has an interesting time of it at the moment, quite frankly. We thought there was a 20 to 30 billion pound black hole that the government needed to fill in the autumn statement, the autumn budget. That now apparently is 51. So it's like double now. So we keep finding ways of becoming more broke. I mean, ultimately, those holes do get filled and it's going to need a bunch of adjustments. But a lot of these holes kind of get generated by shifts in terms of data. We saw an expectation when it came into setting this budget that growth was going to be a certain level and therefore tax receipts will be a certain level and blah, blah, blah. It's all based on assumptions, right? And then when the data comes in weaker than expected, suddenly your tax receipts are weaker. Suddenly your benefit payments are higher. You decide to climb down on your welfare reforms. That carves out a massive hole in your budget. So a number of different things, but that really highlights the fact that the UK data at the moment, in particular GDP, is really key to that story. If we see a bumper GDP number, then that black hole might not necessarily be so bad, but we've just come off the back of 2 consecutive negative GDP figures on a monthly basis. So that's going to be a really important one for the week ahead. Now, we've got the jobs report on Tuesday, GDP on Thursday, then we've got goods, industrial production, manufacturing. So a busy Friday as well. So a lot going on at the moment for the UK. And we've just come off the back of a rate cut from the Bank of England. It had been widely expected. We thought that there was going to be, or markets thought there was going to be 7 out of the 9 members voting for a rate cut. What happened? It was 4, 4, and 1. They ended up having to essentially vote again. And then that tipped the scales in favor of cutting rates. So it was like, wasn't even a given that we saw a rate cut. That time around, we saw the FTSE 100 start to weaken. We've seen the pound strengthen because suddenly things aren't necessarily looking too dovish in terms of the UK, and for good reason, because of inflation. But certainly it's a sort of weighing up of like, how weak does the GDP data or the UK jobs data come out versus how high is inflation, and how much does the Bank of England care about these two things and play them off against each other. So like I said, 2 consecutive months of negative GDP in the UK. There's an expectation this time around it's going to come in at 0.1. So we will potentially break out of that, but maybe we don't. And you see in the past, generally, when you see 2 consecutive months of negative GDP, the third one always bounces. You know, there's nothing within this chart that shows 3 in a row. So it's quite rare to be seeing that, especially outside of any sort of period of crisis. So if we're looking on the jobs perspective, unemployment starting to rise, the claimant count starting to rise. So the jobs market starting to show signs of weakness. The GDP numbers showing weakness within the UK. And so that sort of pulls it on the side of potentially easing more. But then you've also got the fact that inflation continues to rise. So you really do have a bit of a predicament. So really, it depends how much we see in terms of weakness of the UK jobs market or GDP numbers to see if it actually drives people to think we're going to start seeing rate cuts in September once again. In terms of the jobs numbers this time around, expectation of a decline in terms of unemployment. And then employment change, we're expecting to see down to 65, so a weakening there. Then in terms of the wage figures, expecting to remain at 5%. So a little bit of a mixed bag expected there. Let's just jump into the charts once again and look at what's happening in terms of the pound. Now, from a wider context, you can see that we are very clearly within a wider downtrend, but you can see that we're probably stuck within something quite similar to this, right? So, you see the sell-off and then you see a phase of consolidation where you keep coming roughly back into resistance, but you know that generally the trend is downwards. That looks quite similar to what we're seeing here, right? So you can see on the top end, we've got something like that. We've got a possibility of trendline support coming back into play down there. So, but it does all point towards potentially near-term upside, but we don't necessarily know how long that's going to last. Maybe it starts to weaken soon enough. Now, notably, you're looking at the pound against the US dollar. So where do we see things happening in terms of rates over in the US? Well, things are starting to take a notably dovish turn. Inflation, certainly not a problem in the same way as they are in the UK, but that CPI number is going to tell us a lot for the week ahead. In terms of the UK, inflation is a problem, but so is the GDP and their jobs numbers. So let's see exactly how this shapes up. If we see relatively strong numbers, then that should embolden the bulls once again. You can see that we've seen a bit of a pullback or a decent sized pullback, come into 1313 support, started to rebound once again. Certainly you could say this is a topping pattern. It potentially could be, but certainly if I was going to look out for a key level, it'd be 1358. If we break up through that level, it gives me greater confidence that the bulls are back in charge once again. Really what we need to see here is something quite dramatic in terms of weakness on the jobs front or on the GDP front to make us think that, yes, they were very indecisive about whether to cut this time around, but they'll do it next time as well because the economy is in such trouble. And I'm not necessarily sure that that's going to happen, in which case it points towards the possibility of further upside to come here for cable. And then finally, let's look at the outlook for Australia. Australia has a rate decision this week. The RBA expected to cut rates down to 3.6% on Tuesday, Monday night, coming into Tuesday, depending on where you are in the world. We've also got wage data on Wednesday, and then we've got the jobs report on Thursday. Now, crucially, we've got a position where the Australians have essentially got inflation under control now. It's by and large at target. It's around that 2% mark. So they're not necessarily being held back on that from that perspective. In terms of unemployment, they've remained relatively stable for a while now, but things have started to shift a little bit. Unemployment started to tick a little bit up, and we've seen a distinct lack of growth in terms of employment. You can see that here the past 2 months, the employment change figures have been essentially non-existent. So the RBA is in a position where it can ease, given the fact that inflation is now under control, and the jobs market is showing that perhaps they should ease. Now, they've been very patient thus far, but we need to see exactly where we go from here in terms of rates. Now, the expectation is that we do see a cut this time around, 93% attributed to that. But from there on in, where are we looking? The next rate cut in November, potentially, that's around 76% chance that we've got priced here. So we're expecting one more cut by year end. Really, the fact of the matter is markets don't necessarily have a great grasp of exactly the direction of travel in terms of the speed of easing from the RBA. And so that's why it's going to be particularly interesting this time around. Markets already pricing a 93% chance of a rate cut. So that already feels like it's baked in. And so the volatility is likely to come around those expectations. Yes, we've seen a tick higher in terms of unemployment. It remains significantly below many of the other major nations around the world. So will they take a cautious approach once again? Will they come out with a particularly dovish stance? That remains to be seen. And if we're looking at, say, Aussie dollar against the US dollar, let's just jump into that to round things up. Now we can see let's go full screen here. We can see a very clear downtrend, much like that cable chart. This one's actually a lot cleaner. And you can see that we've been set within this phase of upside, really in line with Trump's presidency, right? So he came to power around here, and it's just been gaining ground as the US dollar loses traction. This could shift if we start to see the RBA taking a more negative tone, or not negative, but essentially a more dovish tone going forward. But I don't necessarily know that we're there quite yet. I want to look out for this level here. If you look at this as a potential retracement, you can see coming into a deep fib 76.4 and now starting to regain ground once again. So yes, we've seen this lose some traction recently, but the bulls are starting to regain ground. A lot of it's going to come down to what the view is of the RBA and whether they deem it necessary to start ramping up the easing process. But when they hiked, they didn't hike to the same degree, so that it's not like they raised rates to 5.5%. So they've gone a bit easy on the way up. Now they're taking it a bit easy on the way back down. I, for one, think there's a good chance that we still continue to see this sort of grind higher. But at the moment, we're moving into a phase where both the Federal Reserve and the RBA are expected to start cutting rates at a little bit more of a faster clip. And therefore, you've got question marks on the direction of travel here. But yeah, we've come into 76.4 fib, started to regain ground. I wouldn't be surprised to see us coming into the 0.66 resistance level over the near term. But yeah, an interesting meeting for sure, because we need to gauge exactly where rates are going to go for the RBA and whether they're going to ramp up easing in a more dramatic fashion, given the slight deterioration we've been seeing in terms of the job market of late. I hope that's been useful for you guys. My name's Josh Mahony, Chief Market Analyst. Make sure to like, subscribe, and all that good stuff. Have a great day, a great week, and good luck trading. Thanks a lot.